Hello, friends. Most widows believe the Social Security Administration will tell them all their options when they come in to claim benefits. They believe the representative at the counter is there to make sure they get the most money they are entitled to. That belief is wrong. The SSA representative processes what you request. They answer what you ask. They are not required, and most are not trained, to volunteer the strategy in POMS RS 00615.090 that can increase your lifetime Social Security income by $50,000 or more. This video covers what that strategy is, who qualifies, and exactly what to say when you call. If this is the kind of information nobody hands you at the counter, subscribe and turn on notifications, because neither will the next update. Here is what happens at the SSA office in the weeks after a spouse dies. A woman, 61 years old, recently widowed, sitting across from a representative, fills out Form SSA 10, Application for Widows or Widowers Insurance Benefits. The representative processes the form. The widow begins receiving survivor benefits the following month. The meeting took 40 minutes. Nobody mentioned what her own retirement benefit would be worth at 70. Nobody asked whether she had a separate earnings record. Nobody said the words, delayed retirement credits. That morning, without knowing it, she made a decision that cannot be undone. Margaret Holloway, 61, Columbus, Ohio, September 2019. Her husband died in July. She walked into the SSA field office 8 weeks after the funeral. The fluorescent lights hummed overhead. The waiting room smelled like industrial cleaner and recycled air. She had the death certificate, the marriage certificate, both Social Security numbers written on a yellow notepad, her husband's handwriting, found in the top drawer of his desk. The representative was courteous, professional. He explained the survivor benefit amount. She asked when payments would start. He told her. She signed. What he did not tell her, what he was not required to tell her, was that her own retirement benefit sat on a separate track, growing at 8% per year. That if she had waited to claim it, that benefit at age 70 would have exceeded her survivor payment by more than $400 a month. Every month, for the rest of her life. She found out 3 years later. From a pamphlet at a legal aid clinic in Westerville. By then, the window had closed. That is the moment this video is about. And the thing is, Margaret is not the exception. She is the pattern. The strategy Margaret never heard about has a name. Practitioners call it file and switch. The federal regulation that governs it sits in the Program Operations Manual System, the SSA's own internal rulebook, at section RS 615.090. That document has existed for decades. It is public. It is searchable. And if you walk into an SSA office tomorrow and ask a representative to explain dual entitlement optimization for surviving spouses, most will look at you across the desk with no recognition in their eyes. Here is how it works. A widow can claim survivor benefits as early as age 60. At that age, the benefit is reduced, locked at 71.5% of the deceased spouse's primary insurance amount. That is the number the SSA processes when you file Form SSA 10. That reduction does not reverse, ever. But here is what the agency does not walk you through. If you have your own earnings record, your own Social Security retirement benefit, that benefit does not sit still while you collect survivor payments. Between your full retirement age and your 70th birthday, your own benefit grows by 0.667% per month. That is 8% per year. Up to 4 years of compounding. Between 66 and 70 for most women filing today, between 67 and 70 for anyone born in 1960 or after. File and switch captures both sides of that equation. Claim the survivor benefit at 60, collect it. Let your own retirement benefit grow untouched. At 70, switch. One phone call to 1-800-772-1213. Your own benefit, now at its maximum value, replaces the survivor payment if it is larger. The SSA is required to process that switch. Required by the same POMS RS 615.090 they never mentioned at the counter. The lump sum death benefit the SSA pays to surviving spouses is $255. It has been $255 since 1954. The agency knows what it owes widows. It processes exactly what widows ask for. The question is what you know to ask. Right now, this minute, hundreds of thousands of widowed women in this country are collecting survivor benefits without knowing their own retirement benefit sits on a separate track, growing at 8% per year, uncollected. Some of them have been collecting for 3 years, some for 7. Some crossed 70 last month, and the window closed behind them without a sound. What determines whether that window is still open and exactly how much time is left? That is what comes next. The window question is not abstract. It has a dollar amount attached to it, and once that number is on the page, the conversation changes entirely. Before the math, one more face. Dorothy Engel, 73, Akron, Ohio. Her husband died in 2011 when she was 62. She filed for survivor benefits that same year. Nobody at the SSA field office in Akron suggested she wait. Nobody asked about her own earnings record, 31 years as a school administrator for Summit County. Nobody said the words delayed retirement credits. Dorothy turned 70 in 2019. She did not switch. She did not know she could. Today she receives $987 a month in survivor benefits. Her own retirement benefit, had she let it grow to 70, would have paid $1,390 a month. That difference, $403, does not exist for her anymore. The window closed the month she turned 70. It closed without a letter, without a phone call, without any notification from the agency. She says she did not know what she did not know. That is the part that is hardest to look at directly. So here is what has been established. The SSA processes what you request. It does not volunteer dual entitlement strategy. Hundreds of thousands of widows are collecting survivor benefits right now without knowing their own retirement benefit sits on a separate track, growing untouched. But nobody, not the SSA, not the financial press, not the retirement planning industry, can fully explain why this strategy is documented in the federal rule book and yet almost never disclosed at the counter. That question has an answer. And the answer involves something about how SSA representatives are trained, or rather, what they are specifically not trained to do that most people find genuinely surprising. First, the math. Because without the math, the strategy is just a phrase. Here is the baseline scenario. A widow is 60 years old. Her deceased spouse's primary insurance amount, the number the SSA calculates from his lifetime earnings record, is $1,120 a month. She files for survivor benefits at 60. The SSA applies the early claim reduction, 71.5% of $1,120. Her monthly survivor benefit comes out to $800. That number is locked. It does not increase when she reaches full retirement age. It does not recalculate at 67 or 68 or 70. It is $800 a month for the rest of her life, adjusted only for annual cost of living increases. That is scenario 1. Now, scenario 2. Same widow. She also worked for 28 years as a licensed practical nurse in Toledo. Her own retirement benefit at her full retirement age of 67, for anyone born in 1960 or after, full retirement age is 67, would be $1,100 a month. She does not claim it. She lets it sit. Between 67 and 70, her own benefit grows at 0.667% per month. That is 8% per year, applied to the base amount. Over 36 months, 3 years, that compounds to a 24% increase. At 70, her own retirement benefit pays $1,364 a month. She has been collecting the $800 survivor benefit since age 60. At 70, she makes one phone call. She asks to switch to her own retirement benefit. The SSA processes the request. Her monthly payment moves from $800 to $1,364. The difference is $564 a month, $6,768 a year. Over 20 years, a reasonable planning horizon for a healthy 70-year-old woman, that difference is $135,360. That is the conservative version. Here is the number closer to the middle of the distribution. Survivor benefit at 60, $800 a month. Own benefit at 70, $1,400 a month. Difference, $600 a month, $7,200 a year. Over 20 years, $144,000. One strategy, one phone call, one paragraph in the federal rulebook. And here is something that compounds the confusion for a significant number of widows: the difference between a survivor benefit and a spousal benefit, because these two are constantly mistaken for each other, and the mistake costs people money. A spousal benefit is what a married person can collect based on a living spouse's record. The ceiling on that benefit is 50% of the working spouse's primary insurance amount claimed at full retirement age. 50%. That is the hard cap. A survivor benefit operates under a different ceiling entirely. A widow who waits until her own full retirement age to claim can receive 100% of her deceased spouse's primary insurance amount. Not 50, 100. These are separate calculations, governed by separate sections of federal regulation. A widow who spent years collecting 50% of her husband's benefit while he was alive may assume she already knows what the survivor benefit will pay. She calculates 50% and stops there. The actual survivor benefit, 100% of his primary insurance amount, is twice that figure. The SSA does not call to correct the assumption. Which brings the question back to the same place it started. How does a federal agency sit across a counter from a recently widowed woman, process her form, wish her a good day, and not mention a legal claiming sequence that could add 6 figures to her lifetime income? The answer is not incompetence. It is something more specific. And what it reveals about the structure of the SSA's legal obligations to the people it serves, that is where this gets genuinely strange. So what does POMS RS 615.090 actually say? The Program Operations Manual System is the internal guide the SSA uses to train its staff and process every claim filed in this country. It is not secret. It is published online. Section RS 615.090 governs dual entitlement, the rules that apply when a widow is potentially eligible for both a survivor benefit and her own retirement benefit simultaneously. The rule is clear. A widow may file for survivor benefits only. She may hold her own retirement benefit in reserve. The SSA is required, by its own rulebook, to process that restricted application when requested. Required. What the rulebook does not require is for any representative to suggest this option before the claimant asks. That is not an oversight. That is not a gap in the documentation. The SSA's training protocols define the representative's job as processing the claim the claimant presents. The representative is not trained as a financial counselor, not as a benefits optimizer. The job is to take the application handed over and process it correctly. If a widow hands over Form SSA 10 and does not say survivor benefits only, the system processes both. The retirement benefit gets claimed simultaneously. The sequence breaks. It cannot be reconstructed. The asymmetry is worth sitting with. The SSA knows this rule exists. The SSA publishes this rule. The SSA will honor this rule the instant it is invoked. But the SSA has no structural obligation to tell anyone the rule is there before they accidentally disqualify themselves from using it. There is a name for that kind of system. It is not a broken system. It is a working system, working exactly as designed. Which brings a specific moment into focus. Carolyn Brewster, 68, Louisville, Kentucky. She called the SSA 2 weeks after her husband died. She was 63. She told the representative she wanted to start receiving benefits. He pulled up her record. He saw 22 years of earnings as a hospital billing coordinator at Baptist Health. He processed both. The survivor benefit and the retirement benefit started the same month. She did not know there was a distinction to make. Nobody asked which benefit she wanted first. Nobody said the word sequence. At 63, the retirement benefit was reduced, claimed 4 years before full retirement age, locked at a permanently lower number. The difference between what she receives now and what the benefit would have paid at 70 is $287 a month. Every month. For life. She found out 14 months later. A neighbor mentioned the strategy at a church event. Carolyn called a SHIP counselor, State Health Insurance Assistance Program, free federally funded benefits advisors available in every state, who confirmed in one phone call what she already suspected. The window had closed the day she said yes on that first call. A church event. That is how a 63-year-old woman with 22 years of work history learned the federal government had a rule written in her favor. Not from the SSA, not from any letter, from a neighbor in a church hall over coffee. That conversation happens in church halls and legal aid clinics and library reading rooms across this country every week. Not in SSA offices. Here is exactly what to do instead. File and switch requires 3 things done in the correct order. The sequence is not flexible. Out of order, the strategy collapses and cannot be rebuilt. Step 1. Before contacting the SSA, confirm 2 things. First, that the retirement benefit has not already been filed. If it has, even once, call a SHIP counselor before doing anything else. The situation may still be recoverable, but requires a different path. Second, confirm there is a personal earnings record. Log in to ssa.gov, create an account if needed, and open the Social Security statement. It shows estimated retirement benefit amounts at 62, at full retirement age, and at 70. Write down the number at 70. That is the number that matters. Step 2. Call 1-800-772-1213. When a representative answers, use this exact sentence. Filing for survivor benefits only. The retirement benefit is to remain deferred. Do not say, start all benefits. Do not say, apply for everything owed. The phrase, survivor benefits only, is the trigger. It tells the system to process Form SSA 10, the application for widows or widowers' insurance benefits, without simultaneously activating the retirement record. The representative is required to process that request. If there is pushback, ask to speak with a technical expert. That role exists inside the SSA hierarchy. A technical expert carries deeper training on dual entitlement claims and has authority to process what a frontline representative may not recognize. Step 3. Request written confirmation, mailed with a document number and a date, that the retirement benefit has not been filed and remains in deferred status. keep that letter. SHIP counselors can walk through this entire process before the call is made. The locator is at shiphelp.org, free in every state. No appointment required in most. No income threshold. The counselor does not work for the SSA. That last point matters more than it sounds. Because here is what this video has been building toward. The piece that most coverage of this topic moves past without stopping to examine. The SSA knew about file and switch. Congress knew. In 2015, the Bipartisan Budget Act closed a related strategy, file and suspend, for married couples with living spouses. They closed it deliberately, by name, in legislation. They left the widow version open. POMS RS 615.090 untouched. Who decided what closed and what stayed? And who benefits from a rule that exists in the federal rulebook that the SSA is required to honor and that is almost never mentioned at the counter? That answer is not what most people expect, and it changes how this entire situation looks. The 2015 Bipartisan Budget Act is the right place to start the answer. When Congress closed file and suspend for living couples, they were responding to a visible optimization. High-earning spouses coordinating benefits to maximize household income while both were still alive. That attracted attention. That got closed. The widow version, the dual entitlement sequence in POMS RS 00615.090, operates in a different context entirely. A widow is not coordinating with a living spouse. She is facing the system alone, usually in the months immediately after a loss, usually without legal representation, almost always without knowing what questions to ask. Congress has not moved to close it. The SSA has not changed the training protocol. Whether that is oversight or policy is a question for another conversation. What matters for anyone watching is whether they qualify and whether the window is still open. 4 conditions. All 4 must be true. 1. The claimant is a widow or widower. Legal marriage is required. Common law marriage may qualify depending on the state. A SHIP counselor can confirm. 2. Age is between 60 and 69. The survivor benefit can be claimed starting at 60. The window for switching to the own retirement benefit closes at 70. After 70, delayed retirement credits stop accruing and the switch loses its mathematical advantage. 3. The own Social Security retirement benefit has not yet been filed. Not suspended, not filed. If it was filed and later suspended under pre-2015 rules, call a benefits attorney before proceeding. That situation requires separate analysis. 4. The projected own retirement benefit at 70 exceeds the current survivor benefit amount. Pull the Social Security statement from SSA.gov. Look at the estimated benefit at age 70. If that number is larger than the current survivor payment, the strategy works in the claimant's favor. Now, the disqualifiers. Already receiving the own retirement benefit, even at a reduced amount, the window is closed. The sequence required filing survivor first. That order cannot be reversed. The deceased spouse had no SSA-covered earnings record. Survivor benefits are calculated from the deceased spouse's primary insurance amount. No covered earnings, no survivor benefit to claim. Remarriage before age 60. Federal law bars survivor benefits if the widow or widower remarried before reaching 60. Remarriage at 60 or after does not disqualify. One additional coordination point most sources skip: required minimum distributions. The mandatory annual withdrawals the IRS requires from retirement accounts currently begin at age 73. That age rises to 75 in 2033. For widows with significant IRA or 401k balances, the year of the benefit switch may coincide with the year those distributions begin. That intersection can affect taxable income in ways worth modeling before the switch is made. A tax advisor or SHIP counselor can run those numbers. Not every woman who finds this strategy finds it in time, but some do. Barbara Kowalski, 69, Scranton, Pennsylvania. Her husband died in 2017. She filed for survivor benefits at 62 and assumed that was the end of it. One decision, one form, done. In 2023, her daughter heard a benefits attorney on a local radio program mention delayed retirement credits for widows. Barbara called the attorney's office that afternoon. The attorney confirmed her own retirement benefit at 70 would exceed her survivor payment by $312 a month. The window was still open. She had 4 months. Barbara called 1-800-772-1213 in October 2023. She told the representative she wanted to switch to her own retirement benefit. The request was processed. Her payment increased the following month. She said afterward that she felt robbed, not angry, not bitter, just genuinely robbed of the 6 years she had spent not knowing. Then she said something else. She said, now she knew what to tell her sister. That is what this information does when it lands in the right hands. It moves. Here is the full recap. The survivor benefit can be claimed starting at 60. Claiming early locks in a permanent reduction to 71.5% of the deceased spouse's primary insurance amount. The own retirement benefit grows at 8% per year between full retirement age and 70. For anyone born in 1960 or later, full retirement age is 67. Filing for survivor benefits only, explicitly deferring the own retirement benefit, is legal, documented in POMS RS 00615.090, and must be honored by the SSA when requested. The switch from survivor to own retirement benefit at 70 is not automatic. It does not happen because a birthday passes. The call to 1-800-772-1213 must be made. The request must be stated out loud. 3 months before the 70th birthday is the recommended timing, enough lead time for the SSA to process the change without a gap in payments. SHIP counselors, reachable at 1-800-MEDICARE, free in every state, can run the dual benefit calculation and confirm whether the math works. They are not SSA employees. They work for the claimant. Benefits attorneys handle cases where the SSA failed to inform a claimant of options that affected the benefit amount. Some work on contingency. If the window has closed and the circumstances suggest the agency had an obligation to disclose, that conversation is worth having. Every fact in this video is in the Federal Rule Book. It has been there for decades. The only thing standing between most widows and this strategy is knowing it exists. Now it is known. Before you go, subscribe and turn on notifications so the next change does not catch you off guard. And share this video with someone you know, a parent, a neighbor, a friend on Social Security or Medicare. They probably have not heard any of this either. I'll see you in the next one.